Good morning, traders. Today is September 24th. This is Brad Matheny. We are going to go over the ES chart here, and we're going to highlight the rollover of the market and the technical pattern that set up last week, which is very, very important. I want you to understand a couple of key things that are going on here. First, we're going to try to explain what's called the excess phase peak pattern. The excess phase peak pattern is a pattern that we see taking place here, but it's a bit convoluted in the sense that we've had these two sideways, I've highlighted them in these light pink purple lines. We've had two corrective phases here that could be construed as the first phase of a major excess phase peak. And this last move down, this dashed purple line here, represents a very key support level that I want to go over with everyone. So what we're going to do is we're going to move to a Bitcoin chart. And I'm going to show you here that the excess phase peak pattern happens very, very often, and you can see these in price over and over again. So for example, I'm going to highlight them for you very easily on this chart. You can see here, you move this, you can see here that we've got a peak. We've got, so the market's rolled up. We've got this kind of a rollover type of a pattern here. And what we've got now is a sideways flagging formation that normally comes after a fairly substantial downturn. Let me get rid of this and duplicate this. Clone. And a trading view is very good for trying to draw and show you what's going on in the chart. So this is the sideways flagging formation, and what this does is this sets up the first phase of an excess phase peak. Excess phase peak has to rally up to a peak, come down a substantial amount, and then flag out, and then attempt to break through this low, which would be the low right here, coming across, that gives us the potential for a breakdown in price. Now at this point, this breaking down the low would set up what's called an intermediate low formation. An intermediate low formation is a temporary low in the markets that may or may not break down and form a deeper breakdown. I'll show you this as we go forth. So we have our phase A to the top. Phase 2 is the correction and flagging. Phase 3 is the breakdown of the flagging formation, which sets up the intermediate low. And the intermediate low then becomes our critical line of support. If it were to come down and set up this low and roll over and eventually break down like this, coming down like this, roll over, and then break downward, that would indicate that we've completed the excess phase peak pattern. Okay? So we have the same type of a setup here. You can see we've come up, we've rallied to a peak, we get our little excess phase peaking here. Try to draw them in a different color. So I will clone this, draw the same type of a phase right here, about like that. That gives us the same type of an excess pattern. We've come up to a peak, we've rolled down, we've flagged out, we had our support level right across here, and it came down to an ultimate bottom right here and then rebounded. So now you have to understand that this becomes phase 4. So this here, this low, this is 1, 2, 3, 4 to here. If it breaks below this level, then we're into a bearish trend. We're into a more extended downward trending. We have the same type of pattern here. A, B, C, or 1, 2, 3, down to 4. And depending on what happens here, we have to be very cautious. We're back to bearish trending. So we need to watch this level. Once it gets above this level, back to the upside, and the same thing here, then we have to determine that we have a very strong potential. As long as it stays away from this low, we have a very strong potential for upward trending. So now we can come back over here to the peak, and I can show you the same pattern. Now I'm operating off of this intermediate low right here as a breakdown. We could obviously come down to this low here and get the same type of a breakdown. So here we have the same setup. A, B down to here, C flags, D down to here, and then eventually it breaks and comes down to here, which sets up the intermediate low. So let me change, get rid of that. So this is the same setup. Now in this particular case, I want you to pay attention to what happened. This was the big top in 2017, and you can see we've got the same pattern, excess phase peak, and you can see we had fairly strong correction. So in this case, we had a 42% correction. In this case, back here, we had a fairly big correction, a 19-20% correction. Here we had a correction of a minimum of about, oops, come on, mouse, 28%. Okay, so now we've had this area coming around. You can see this was the intermediate support. We never really, I'm going to carry this forward and show you that we never really saw a clear break above this level. And then eventually Bitcoin, and this is a Bitcoin chart, eventually Bitcoin broke down, established a new low back over here. This was the ultimate bottom that took place in 2018 and 19 before we started a fairly strong rally to the upside. Okay, $3,112 approximately. So now we can come up here. You can see the patterns over and over again. I'll just kind of draw them. So we have the rally up, the roll down, the flagging formation here, creating the support level across here, the breakdown, the intermediate support level, let's call it here or here. And again, we can see that it broke downward and continued down to establish a new low because it failed to really get back above this support level. It did once or twice, but it failed up at this area. So understand that this is a pattern that occurs very, very regularly. You can see the same type of scenario is set up over here. You've got the same rally phase up to the top, coming down, flagging, breaking below this level, establishing, sorry, that should be a horizontal line, establishing intermediate support, which is this area. And you can see that in reality, it never really broke down above this level, means it failed at 4, it started a new uptrend. And then, of course, we have the current move, which again is going to set up a flagging formation, but we have to wait for it. So in this particular case, you can see we had a moderate flag right here. We didn't have a substantial move. I would call this the flagging. So here we have the rally back down to this extreme low, flagging out like this, breaking down to the intermediate low, which is across here. And then, of course, we get the breakdown. This did confirm the breakdown to an ultimate low over here. So here's our 1, 2, 3, 4, rallied around, and then broke down for 5. So now we come back over here, and you can see very clearly on this chart, and try to draw it for you, we've got, this is a daily chart. You can see we've got this rally phase across here. We've got this peak. We've got this area here, which may constitute the wave 1 correction. Remember, it needs to be fairly deep. So at this point, this is my concern, is that this level may not be deep enough, and this may be our wave 2 correction with our flagging. So if we determine where we're at, if we look at this as wave 2, so 1, 2, 3 for flagging, 4 for breakdown, for ultimate 4, we are at a very critical area here where we may see the markets break down even more extensively. If this initial analysis is incorrect, and if we're actually looking at this area being the 2 flagging to 3, then we're going to come down potentially here to see 4 if we get this breakdown take place. So there's 2 things again we need to look at. Is this a 4 level, holding at this level off of this being at 1, 2, 3, breaking down to 4, showing a potential double bottom here in this blue or purple dash line area? Or is this the 1, 2, 3 coming down here, maybe potentially trying to break below this and establishing a new support area here? the way this would work, ideally, if I were to clear these lines, let me try to do this and leave the rest of them. If this was our 4, then we come up here, A, B, C, or 1, 2, 3, 4 down here, and then we have this big looping double bottoming formation right here, which then means the markets are holding at this 36, 68, 36, call it 70 area, potentially looking for major support at this area. It means that this becomes our wave 4 area, and that we are now looking as this area as major support before we potentially break downward, attempt to find support somewhere down here. And that's where the concern is for what's likely to come next. Remember, I've drawn this area as potentially a target area going forward. If this is a false move, and let's just for the heck of it come in here and see from here to here is 15% roughly, from here to here is 23%. So by my analysis, I would call this the deeper move, as this is the ABC pattern. Let me try to get rid of this and get rid of that. And I would suggest, my interpretation is I would suggest we're at an A move up to here. Sorry, mouse got a little away from me. Come down to here as a B into our flagging formation here. And we're likely now to roll over, breaking this formation, and potentially, if we break this level here, we're going to move down potentially to this area and try to set up a wave 4. If we hold at this level and rally back up, then we could see a Christmas rally begin to take place, moving a wave 4 correction, and maybe start a broad wave 5 rally. So let me explain to you how this sets up from a standpoint, hopefully on the weekly chart. So let me come up here to weekly and let you know what's going on. Now I'm going to try to highlight this because we've got a lot of activity going on. So ideally we have this peak up here which identifies a potential correction, and the potential correction would most likely be somewhere within this range on a Fibonacci basis, somewhere in this range. So we have our 25% correction at 40.79. We have a 3.82% move at 36.87, which is very, very close to our bottom. We have a secondary move here. I'll have to increase this, make it a brighter color because I can't see it. So 682 should be this one, I believe. And we'll make it a very bright color. Still need to make it a little bigger. Let's see, fonts 10. Okay, so it's kind of hard to see here, but let me come here. And this is 33.36.62, which is down in the area where I'm highlighting this support in this blue line. So you can see my levels are in alignment with Fibonacci for the most part. I've been doing this long enough that I see things in Fibonacci price moves, and you can see that this level here, this ultimate low, is near this 618 level, and that's because I do visually see things in Fibonacci price structure. So now when we're looking at this, what we have is a scenario where, is this the apex pattern? So let me try to move this to monthly. Is this the apex pattern of the corrective move in the markets? Are we flagging out right here and coming down to a double bottom right here, which is again our big, and you can see this here. You can see this big A coming up, B flagging out, and then potentially a C move down to here, and then we need to see some rotation And eventually, if it breaks this, or if it gets above this level, this becomes our critical level. So going forward, anything above this level, this 36 roughly on the S&P, 3640, 3641, anything above that level is technically, in my opinion, still holding up above this A, B, pennant formation, flagging formation, and is still technically bullish. We get below this level, then we're going to be looking at 3412, 3410 on the SPY or on the S&P, which would be roughly 340 on the SPY. This would put us at 364, 365 here on the SPY. So anything above this level is still technically bullish. Let me change this to light green. Anything below this level would be more bearish, and it would possibly indicate that we are now in a downward trend, potentially moving into this area and then possibly even lower. So we're at a very critical juncture at the market. The Fed has tried to derail the market, but the U.S. market's very strong. The U.S. dollar is very strong. My custom index charts, as you'll see in the next section of this video, are still indicating that the markets have not broken into a bearish trend yet. We are very close. If I spread this out and show you, we are very close to potentially breaking into a bearish trend. Monthly, we've rolled over. We've rolled over, what, 22, 26%, something like that. From here to down into these low levels is 22%. So we are technically in a intermediate downward trend, you could say, based on the amount of pullback we have. But the volatility we're seeing in the market right now and this excess phase peak pattern that is setting up tells me that we are very likely in this phase 3 move. So it would be 1, 2 to an immediate pullback bottom, 3 flagging out, 4 potentially breaking this low, which we haven't done yet, and establishing some new low, which could be here or potentially down here, but we haven't done that yet. So again, if we take a look at the Bitcoin chart, I've shown you a lot of examples where the market has flagged out and moved down. Oops, I didn't want that. But there's a ton of examples where it's flagged out. So for example, right here, we have the same type of flagging formation. You can see we've come up here, rallied, oops, wrong one, rallied up from right here, come down, flagged out here. Here's our ABC. We have our support level right across here. And you can see that it never broke below these lows. It danced around these levels, rebuilt support, flagged out, found support, double, triple bottomed, and then rallied higher. You can see this over and over again. I can find examples in almost anything that's going up that's done the same thing. Here's another example. Rallied up, come down, flagged out, tried to find support across here. Sorry, my mouse. Couldn't find any breakdown level. Eventually rallied across these highs, which I'll try to draw like this. And eventually moved higher and got into a new bullish trend right back over here and continued higher. These happen, these are what are called failed triggers. They happen, it's something that takes place. You need to understand that this flagging formation can either confirm and break downward, or it can fail off of this 3 or 4 pattern and continue to move higher. So here's probably another great example right over here. You can see this move here. It's established a pattern. Let's see if I can draw it. This is a weekly chart, so, or sorry, this is daily. So you can come up here, you can see the peak. We came down, we flagged ever so briefly, broke down to our 4 level, which was a bit of a solid correction, and then failed off of 4 and rallied perpetually. So this is what we have to be cautious of, is the markets are very near to this type of a pattern. Okay, now if we take a look over here at gold, which everybody wants to know what gold is doing, okay? And so now I need you to understand this. This is where we're at with gold. Let me get rid of some of these lines and highlight the same type of pattern, okay? So we're going to come up here. We're going to format the A wave or the one wave up to the peak, and then we come down to a base, and then we flag. So here's our broad flag in gold. Now we've come out of that flag. We've come right down below these lows on a monthly basis. We have a little bit of time to go yet in September. We're looking at these lows, these flagging lows, to hold up, potentially hold up. You can see I've drawn here, this level is the low. I'll make it big and thick and multi-tiered so you can see it. And this means that we are waiting now to see if this is going to break down to form some new lower low, which obviously would probably move into these areas here. And this would become our wave 4 low. If this happens, we would be looking at this as potential critical support, given the excess phase peak and the fact that we would be looking for the markets to recover the 2020 COVID lows, which are back down over here. So we have this same setup, this 1, 2, 3 over here to a flag breakdown. We're right now at a temporary potential breakdown of this low, which could indicate deeper move to the downside for metals, likely targeting this COVID low. This could potentially be a big washout, showing that we've had economic destruction, wiping out down to these COVID low levels, which would be a very big support level for gold. And understand that if we fail to break down below this level, if we get kind of a washout pattern over here, which is, imagine it comes down, it comes back up, and I drew that a little deep. But if it comes back over here and builds strength and moves higher, then we're looking at the same type of a pattern that we have seen over and over again in legging up moves. So here's an example, okay? It's kind of hard to see, but give you an example. We come up, we flag down, we break our flag, we come down, we do not break our low level of support. Sorry, that's supposed to be a horizontal line. And we rally higher. Oddly enough, we get the same type of scenario back over in a number of areas. You can see gold. I'm going to try to find a good example here. Come up, flag, flag. Here's a deeper one that did come down to a 4 but never broke downward. So here's another example. It rallied up, came over, flagged out, broke down to 4. It broke the 2 levels. This becomes deeper move. This becomes support. So it never got below this level. After setting this level, it rallied back above our flagging level. This area now becomes bullish again, moving back to the upside. So if we take a look at this from the gold standpoint, where we're at our flagging low right here. We're just below this level. If it recovers and moves back up over the end of this year and never really establishes a deep breakdown low, then we are looking for bullish activity in gold, and this is just a big washout pattern. If it breaks below this on extended selling next week, then we're looking for gold to move down here to 1473, 1475, potentially establish a wave 4 low, and then we'll see what happens beyond that with the market. My personal opinion for metals right now is I think that the markets are just, the U.S. markets in particular, are just washing out this flagging formation. I don't see any confirmation of extended breakdown yet. Gold is indicating we're potentially having a washout low on this monthly basis, but we're way back down here into COVID highs, pre-COVID highs, and the recovery level. So it would take a fairly big washout in the market to move this down. Could happen. It could happen, ladies and gentlemen, with the Fed and global central banks and what have you, but I'm not seeing we're there yet. I really don't see that yet. I don't see confirmation. We only have about 4 more days trading in September. We need to see what gold and silver do at this point and whether or not this level holds. So a deep, deep low, as I've highlighted right here, I'll edit this one so you guys can pay attention. This would become my alternate breakdown support level for gold, and understand that this level here, which is 1630, ultimately gold could dance around in this little window and still technically be bullish, in my opinion, because we could be just scouting this low, trying to move into a range where it's looking to see if it can break lower. And if it cannot break lower down into this area, then I would still consider this bullish. But ultimately, ladies and gentlemen, again, what we're seeing is this A, B, C flagging, potential breakdown, potential double bottom. We don't know where we're at. We likely need to see this move back up into this pennant formation. If it doesn't, if it breaks down excessively, then we're headed down here to this 1475 level. If it holds over the next couple of weeks and months, then we could attempt to reestablish support and attempt to rally higher. That's basically the general message of everything. So I'll come back to the ES chart, show you again. Everything is setting up like this. Everything. The NASDAQ, the Dow, everything is setting up in this pennant formation. We've got this thing setting up where we could be in a broad flagging, double bottoming formation off of support right here. We have this little window where we could see a little bit of a deeper range trying to find support down in this area. You can see I've drawn this line. This is a Fibonacci line. And I will try to draw this here because this is a fairly critical level. I will edit it. I will make it the same yellow color, thicker, and highlighted. And understand that these are the critical levels we have to play with. If it gets below this yellow level here, this real deep support level, which on the S&P is 35, 34, then yeah, ladies and gentlemen, we're probably looking at a deeper wave 4 level back over here. When I say wave 4, a deeper excess phase peak. Phase 4 level over here, trying to find support at 28.58, 28.60, and then potentially even breaking down deeper. This would be the global markets enter an extended default phase. And when I say an extended default phase, it would likely be that we are seeing, and it wouldn't quite be this aggressive. This was drawn because I moved the mouse kind of funky. It would be more along the lines of an A, B, flagging, 4, rolling around 4, and then potentially moving back down into this area here, which would be our washout type of a crisis mode. This would likely result in weaker foreign markets defaulting or entering into some sort of a Greece type mode or Puerto Rico default type mode where debts would be abolished, and the stronger economies, the US, potentially China, potentially Europe, would then become some of the strongest economies on the planet. Because if everything else is going into default, then traders are going to start looking for the most robust, healthiest economies. Even if they're debt laden, they'll still be considered the strongest currencies and strongest economies on the planet. So we're really at a kind of a wait and see mode, which is what you're going to see in my analysis. We need to wait and see what's going to happen over the next 2 or 3 months and play it very cautiously. All right, let's move on to the custom charts. Good morning, ladies and gentlemen. Today is September 24th. This is Brad Matheny, and we're going through our custom index charts. We're going to start off with the FANGs index, excuse me, and we are going to highlight this middle green area right here, this kind of reddish line right in the middle that has been historically moderately strong support. Now, the FANGs index, the technology index, broke down with the general market last week. We have a very clear potential A, B, C, D, E type format that could move down here to these lows, just like we saw back here with the COVID lows. But we are in kind of a new phase with the Fed raising rates by 3/4 of a basis point, extending potentially downward with technology. But we need to see how this holds up, because historically we've seen this level be very solid support. We're back in the middle ascending range for the standard deviation channel, and right now we're not seeing very aggressive downward selling. We are obviously in a downtrend. You do not want to be holding a lot of technology stocks, but we need to see how this holds up. I'm still looking at this as a broad unwinding, and we need to see how this holds up, whether the markets find support over the next 30 days and start a Christmas rally, which could be a move right down to this lower green area and then back to up to this area or higher, or whether we see a broad breakdown. We're already very well protected because we pulled our capital away from the markets back in August, September of last year of 2021. So again, markets are moving lower, FANGs are moving downward. This is not something we want to try to buy into yet. We're seeing no clear signs of a change in the market trend. We take a look here at the U.S. stock market index. It broke down lower. It's behind this little post sign. I drew this purple line here because this is, again, setting up a very interesting double bottoming formation. I highlighted this in the first part of the video. We've got this broad phase peak here up into the end of 2021, down to an initial bottom, rallying back up into a phase 2, excess phase peak, phase 2 flagging formation, breaking down and stalling last week above this low. Understand that above this low here, we still do not have any technical confirmation of a breakdown. So we could see it over the next couple of weeks. We could see the markets really break downward, or we could see the markets surprise us over the next couple of weeks, where capital rushes. And again, think of this as the Fed's raising rates. It knows it has to break inflation, but foreign markets are much weaker than the U.S. market, and capital could be flooding into the U.S. dollar, the U.S. assets, the U.S. stock market, and that could bounce the U.S. stock market a little bit higher going into a historic Christmas rally. Historically, at the end of every year, except right here, when we had the Fed really blow things, we saw a substantial rally phase. You see here at the end of the year, we get a 3-month rally roughly. Over here at the end of the year, we get a 3-month rally. Over here at the end of the year, we get a substantial rally. Over here at the end of the year, even though it's hard to see, we did get a decent rally up until the peak, and then it broke down in early 2022. That same type of Christmas rally could happen this year if consumers stay strong and if the U.S. economy does not fall off the rails. So we could see this bounce. That's the message this week, is we are weaker, yes. We are in a downtrend, yes. It looks like we are in a downtrend. Are we into bear market trading longer term? No. We could see a very strong bounce or a moderate bounce here, and it just depends on how things play out over the next couple of months. So now here is the Smart Cash Global Index. Understand that it has broken down lower. This was a very big breakdown last week in the Global Market Index. Europe, Asia, China, they're all breaking down, and mostly because of recessionary fears, where they're basically having to deal with a slowdown with the economy and or COVID and or war concerns like in Eastern Europe. So we're seeing this really move into a deeper decline where the U.S. market has not yet reached that. And I'll show you here with the U.S. to Global Market Index. So foreign markets are very weak compared to the U.S. Okay, and I'll show you that here in a bit. The metals index. Metals were under pressure last week, but and I showed you this in part 1, that even though this metals index is showing a breakdown, we still have the chance for moderate support. If this were to roll back up and try to find some support here off of this support channel here, which is again level, we'll see how it holds up. I'm advising traders to play metals very cautiously right now. We have a very small position in metals. We're using it as a hedge. If the global markets contract excessively, which we're seeing, and the U.S. market inflationary trends weaken a bit, we could see the Fed move to a pivot, and it could just be a 50% rate increase or a 25% rate increase, or 25%, a 25 basis point or 50 basis point rate increase, which would be slowing down compared to the 75 basis point rate increase. That would be enough to indicate a Fed pivot, a moderate Fed pivot, and could send metals substantially higher. So we're in this very deep sideways pennant formation, potentially breaking down off of the Fed news and the CPI data. But again, this could all change on a dime. So do we want to risk getting out here, watch it roll over when we're effectively hedged with a very small position of metals, or do we want to just ride this out, see what happens with the Christmas rally, and give it another couple of weeks to see what happens? My opinion, at least with my holdings, is I'm going to hold this because I really believe that we're in a shifting market, a very big shifting market, which could be kind of like this COVID bottom setup. We could see it bounce a little lower next week and then just roll right a bit higher, and 3, 4, 5 weeks from now be back up into this 440, 450 area, which would be 1870, 1925 in gold. And I believe that gold could shift very quickly in this manner. Okay, so now we're going to the valuations index. The valuations index helps us measure how traders are effectively valuing assets in the U.S. and global markets. The idea here is that when traders believe that we are going to have increasing valuations, and you'll see the valuations index move higher like we saw in the speculative phase. Or as you can see here, back in 2018-19, we rolled off of this low, then rolled into a very strong upward trend. Same thing here, 2021. All the way through here, the middle of 2021, we saw the valuations level increase, which tells us that traders are expecting the market and the valuation level of stocks to increase and move higher. Right now, traders are expecting the valuation level of stocks to decrease, and we're very, very close to extreme historical deep lows. These extreme historical deep lows indicate to me that we could be very near a bottom in the market. Yes, we could continue to trade downward and sideways over this extended period of time. We're watching for that, but understand that we could also be fairly close to a market bottom here, given what's going on, given the current devaluation of assets. We've seen this massive speculative bubble unwind. We could roll back into a deeper move, maybe at this point another 2, 3, 4, 5, 6% down. Or we could be setting up some potential bottom. We really need to stay cautious here and kind of hedge ourselves in case the market breaks in a new direction. Next, we have the commodity to gold index, which is showing us that essentially commodities continue to unwind. I mean, they're really moving down into extreme new lows at 1.0. You can see this little dash line right here. It tells us the price level going back. I mean, we're lower than the 2018 economy lows. We're lower than the lowest point in December 2018 when the Fed kind of blew up the market with a surprise rate increase. We're down near the mid-COVID low area. Another, if we move down here to 0.4 or 0.5, we would be down at the extreme COVID lows or close to it. So we are at a very deep expansion, contractionary phase with the commodity gold index, and this is going to turn into deflationary pricing pressure eventually. You saw oil close at 79.43 on Friday, down almost 5%. Who in their right mind thought that oil at this point would be moving downward besides me? I know a ton of people thought that oil was going to just continue to skyrocket on demand concerns, but not when consumers are changing their spending habits and not when interest rates are going up. You're going to find that consumers are going to find alternate modes of transportation, electric bikes, electric scooters, possibly motorcycles. I'm seeing a lot of that out here in California. Electric bikes have become a very big thing And that's something we have to be aware of. The markets move in cycles, and we're getting very close to deep devaluation, which means, FYI, that CPI and CCI could, and I mentioned this, could suddenly move into a downward trajectory over the end of the year, depending on how energy prices move and how we see the general commodity demand move over the next 90 to, call it, 180 days. Okay, now this is one of the volatility index chart here. This is one of the most important charts that I like to follow. And you can see we've come down very close to deep selling. We've been there many times over the past year. This year, this you can see here, this red line. We've been there very, very closely over the past 7, 8, 9 months. But ladies and gentlemen, we're back there again. We're at 6.43. 6.43 is moderately bearish. I would tell you that we'd have to see a breakdown in this area to move into bearish trending, a bigger breakdown in the market. So understand we're just not there yet. We're back into this tightening, congesting phase. And depending on how we count the phases, if we count a rally move up to here, then a breakdown to here, we could go 1, 2, 3, 4, 5 breaking down. That would be a breakdown phase, 1, 2, 3, 4, 5 breaking down. Or we could count this as a 1 up, 2 down to here, 3, 4, and then a Christmas rally phase coming out. So I'm kind of holding my breath right now. And I will tell you that if we move down below this next week, if we get down into these low levels, then we'll likely be forced to move some of our positions a bit lower into metal. If, for example, metals and bonds, we'll move those lower, possibly even stocks, and move more into cash and kind of wait out whatever happens next. But right now we're in this low phase. It hasn't indicated any big downward move, and because of that, we're kind of riding things out. Okay, that's the end of these. Let me come to where am I here? Okay, the volume ratio index is weakening. You can see we had much weaker spike in volume. We're still in a bullish trending. We haven't seen this big downward spike that took place at the beginning of 2022. That indicates that we're seeing a big breakdown in trending. We haven't seen that yet. We're still holding up. So again, volume is not indicating massive selling pressure or a big shift in the market, but we will see. The custom US valuations index is flatlining. Actually, this is from the 16th. I'll have to update this. But it is flatlining. It's back down near these lows again, which again, these lows, I've shown you over and over again how this has got to set up into a flagging formation and hold up. We could see a breakdown, but right now we're cautious. We're just cautiously waiting to see what the market wants to do. The large cap index is flagging sideways. You can see here, this is a monthly chart. We have no big breakdown. We have no big change in trend. We are in a downward trend. We are near lows, but we are still holding up. I mean, this is basically showing us that the large caps are holding up in valuation comparatively to the June lows. So we're not seeing massive breakdown in the market yet. Massive breakdown would look something like this, okay? Just continued downward bars. You can see we haven't really seen large cap US stocks really break down much at all. We did here 2012, 13. We did here in 2015, 16. And now we may see some breakdown, but as of right now, we are sideways flat, which gives us a little bit of hope that we could be basing and bottoming right now in the US. Okay, here's the US2 Global Market Index. You can see that the Global Market Index has moved quite a bit lower. It's minus 6% since 2017. This starts at the beginning of 2018. Beginning of 2017 back over here. You can see the US market is plus 41%. There's a big difference here. There's almost a 50% difference in returns. And again, depending on what happens in the global markets, I've talked to you guys about this a lot of times, but this time is different than 2008, 2009. we may not see a massive US-based global market collapse. Will likely see some asset prices collapse, but this time it's going to probably be more Europe and Asia. And that means that we have to, and possibly Africa, possibly even South America, but mostly Europe and Asia, because Europe and Asia have been gorging on cheap credit and cheap debt through the expansion of the Belt Road project and the Eastern European countries throughout a lot of the Arabic countries with the Belt Road project. You've got a lot of countries that have gorged themselves on debt, possibly in the Gold Coast area in Africa, Ghana, and those areas. But the real reality is this is the unwinding that's taking place globally. And this is what's driving deflationary pressure in the U.S. as well, because it's going to decrease demand for lumber, for copper, for oil, and energy products. And it's likely to send precious metals quite a bit higher as global fear starts to permeate the market. Whereas the U.S. market, the strong U.S. dollar is holding up okay. Remember, these are the COVID highs back here. So we're still above the COVID highs. We're still technically above the 2020 start point, the 2021 point. We're actually below the 2022 start point. We're actually below. But if you think from 2017, 2018, 2019, we're still, over the last 3-4 years positive. Whereas from Europe is negative from 2017, negative from 2018, negative from 2019, negative from 2020. This is Europe and Asia. Negative from 2021 and negative from 2022. So basically they're almost at all-time new lows for every starting point for every year going back to 2017. And it's likely that Europe and Asia will contract at a steeper rate than the US, like it's been doing. Next, we have the custom global asset index. So this is a measurement of global asset prices, which includes the US and foreign markets. And you can see that we have moved a bit sideways. We are flagging out down here near these lows, which again, we have to be very cautious. We get below these lows on a big breakout, I will alert you that we need to adjust our portfolios very quickly. Right now, holding up in this box is telling us that we're possibly seeking a bottom. You can see we've moved downward here. You can see we had this downward trend here in 2012. We're kind of down in these levels right now, down in these same levels right back over here. So it wouldn't be unusual to see global central banks pivot, some excessive moves to try to support their economies, and try to move us back into somewhat away from this lower phase into a growth phase. So we'll see how it plays out. The next year or two, as I've been telling you, could be the biggest opportunities of your lifetime if you follow my research. Okay, that's the end of these. So now we're going to move into the real estate index, and we're going to go over the Mint rotational modeling system stats. Nothing's really changed. And then we're going to go over Bitcoin and a few others. All right, ladies and gentlemen, this is Brad Matheny again. Today is September 24th. I'm doing these in sections now instead of one big video. Okay, so now the rotational modeling system is still the same as last week. S&P or SPY is bearish daily, bullish weekly. Transportation index is bearish daily, bullish weekly. Dow Jones Industrials, bearish daily, bullish weekly. Let me zoom these in a little bit. The ES is bearish daily, bullish weekly. The NASDAQ is bearish, bearish. YM is bearish daily, bullish weekly. Gold is bearish, bearish. Based on the rotational modeling system, it is trending downward. Silver is bearish, bearish. Crude oil is bearish daily, bullish weekly. And bonds are bearish, bearish. Now, we're not changing anything with our allocation levels. We're holding everything just like I mentioned to you. The markets are holding up in a very interesting form. We have that excess phase peak type pattern, which you may be able to see right here. Sorry, you're seeing a bit more of my screen than normal, but We just went over this and highlighted this excess phase peak and how critical these low levels are, these lines. These are going to basically determine whether we go up for the next 2 or 3 years or whether we break below this pink line and go down for the next 2 or 3 or 4 years. Ultimately, maybe targeting this 2000 or this 1800 level on the ES. And that's why it's so important that we pay attention to where we're at with our allocation. Right now, we are prepared for a breakdown move where we see the markets change direction potentially aggressively, maybe Fed central banks change direction. And what we're doing is we're hedging our position. We have a very small stock position. We're holding mostly in cash, which gives us the ability to profit from the strengthening US dollar. We have a very small gold position, which gives us, or precious metals position, which hedges us against an excessive risk factor. For example, like war or central banks moving aggressively because of some credit crisis. And we also have a very small position in bonds where we can take advantage of potential change in direction in bonds. Now, as an alternate setup, if you don't have the ability to hold metals, and again, I would urge you, if you don't have the ability to buy a fund or into anything like GLD or SIL or SLV, in reality, go out to your local coin shop or your bullion shop and try to maybe pick up, some physical coins. It's a great way to hedge against a crisis. There's nothing like holding on to something like a physical silver bar or gold coin. It's an alternate form of savings and cash, and it's very, very handy. Okay, so now you have access to these under the member area. Things are changing in the members area. By the end of this year, I'm going to have to make some big changes, but they're going to be very, very positive. Next, we have the setup on the indicator. So weekly, we're still bullish the SPY. We have a 25% allocation. Our last trigger was 6/10/2020 from 319. This should be updated as of now. We've got a 15.22% update or profit in the trade. And the daily, which is bearish, the SPY, we've got a 75% allocation. Last triggered on 9/31/22. I gotta check that because that is actually incorrect. I'll have to fix that because that's 3 days from now. At 395, we actually have a 367 price here. This is probably 8. I probably typed in the wrong number. We have a almost 7% profit in the daily side. Now remember, you handle these as 2 separate accounts. If you are unable to handle them as separate accounts, then you can, for example, if you can't long 20% and short 75% in one account, you can potentially take advantage of the inverse, the SDS, and offset them that way. Historically, this is what the momentum reversal system has done. It's performed extremely well. I'm putting the metrics data up on the website. One of the changes I'm making right now, I want you to be aware that this is the basis of value that I deliver to you for free at Ment.com. This is the system that continually outperforms the S&P and helps us stay active in the trades. Now, when we get to the allocation levels, I use these as a method of trying to teach you to protect and pull your money away. So this is 100% invested all the time. 100% capital is always invested in this system. When we move capital away from the system or from the markets, we're just moving it into cash. You're still going to have the profitability of these systems working for you, but we're just moving some of it into cash and avoiding risk of contagion at this point. So you need to understand that when we're talking about allocation levels here, this is broad allocation levels for active traders who understand the risks at play. When you're considering the momentum reversal system, or the rotational modeling system, I want you to understand that this is always 100% in the market with 100% of your cash. It's always trading in the two accounts, the SPY, some bullish, some bearish, and it's broken down 25% weekly, 75% daily. That generates these results here. Okay, next we are going to go to the real estate conditions. Real estate, let me move this up. Real estate is flatlining. I'm telling everyone that it's flatlining. It's very, very interesting to see price trends. This is a custom metric here. Price trends have actually tightened because inventory is so short. This is as of last week based on realtor.com data. So understand this is 1 week behind, generally about 10 days behind. We just had the CPI and CCI numbers come out. We also had the Fed raise rates last week, pushing interest rates higher. It's going to be very interesting to see what happens in these next graphs. So online active listings have been collapsing. Real estate price reduction activity has been collapsing. It's almost like the market was settling into a mode that it was expecting the Fed to try to weaken their aggressive stance to raise rates, and that tells us that we have a market that's kind of sitting in sideways, flatlining, waiting to know what's coming next. Well, we just found out what's coming is higher interest rates and an aggressive Fed unless something changes, and we haven't seen that literally since the end of 2018 when the Fed raised interest rates and then moved everything aggressively lower. So I'm expecting the new listing counts to begin to move higher. I'm expecting the new count here, the blue line, to move higher, new listing count change to move higher, and I'm expecting the markets to actually move into a downward price trajectory. Oops, wrong direction. I need to move over here to this chart. And what we need to see here, what I'm expecting to see here, ladies and gentlemen, is a rise in the reductions count. So this is the reduced count. We're starting to see that rise back up again. Active listing count is staying elevated. So it's moving higher. It is higher. It hasn't really begun to decrease. Median price listing has begun to drop, but it kind of went up over the last 2 or 3 weeks. Price reduction share, which is this light blue line, has stayed fairly elevated, and I believe it's going to continue to move higher. And days on market is likely to move quite a bit higher over the next couple of weeks going into winter. This is a big shift. Another 75 basis point rate increase could send the real estate market into a bit of a reconstruction mode. So now you can see here again, this data is 10 days old, so it doesn't reflect the Fed move or anything else that's happened over the last 10 or 15 days. You can see here that price demand is very weak. So look here, real price factoring is minus 34%. That would be year over year. Weekly change, it went up just a small percent over last week. Modeling market demand is minus 43.97. Demand went up a little bit, and that's because people were expecting the Fed to weaken, to move into a more conservative stance, maybe only move 75 basis points this time, and then tell everyone they're going to stay flexible and adjust to market dynamics. What happened was the Fed came out and said, we are focused on eliminating and terminating inflation, and we will do what is necessary, which means they could destroy asset price valuation and home price valuation markets. So we need to see how this plays out over the next couple of weeks. It could be very, very interesting. Okay, next we are going to move to the watch list. Here we have the TT Scanner watch list for this week. We have a bunch of new triggers, kind of interesting to see. Healthcare is breaking down. That is likely related to the NASDAQ breaking down. We have a new trigger here. This was last Monday. We're already 3.2% in the profits. Our trade trigger was 79.26. We have a new trigger here on REITs are moving downward. That's a very solid indication that the housing market is weakening. It is entry price was $23.99. We're already 5.84% profit. Haven't hit any targets yet. And the communications sector is moving downward as well. XLC, new trigger at 52.60. We're already 5.5%, 05% profit in the trade. We have flat trades here in RWX real estate. It was in a position last week, and the let's see what this is. Materials, Select Spider, SBI Materials. So I'm assuming here raw materials are weaker and moving downward and flattening out. Our other longer term positions are XOP is still long from 32 weeks ago. We have a stop at 110.57. We're at 118.61, only about $8 away. We have XLE long for 36 weeks, it looks like. From stop is at 60. Sorry, it's our entry price. Our stop is at 107. We're at 118, so we're $11 away. Stop is 66, 65, 65.32. We are at 70. 48, so we're only about $5 away of a stop here on energy. We also have our gold miners and nuggets here. You can see we've got 38% in profit in nugget, 23% profit in GDX, and 18, almost 19% profit in GDX here. So this was GDXJ and GDX. You can get these in the TradeTank.com member area. That's the Trade Tank website, which looks like this. And when you're in here and you read the market updates, which are these here, the Trade Tank market gauges, you have access to all of the hot lists right down here near the bottom of my weekly update. So here are the TT scanner hot list here, and then I post the extra hot lists in, let me get to them, market gauges. Looking for them. Here we go. Core inverted hot list. So you can see I post the extra ones here. And again, if you have trouble reading these, you can just right-click, save image to your local PC, because this does not have a expand mode. But long and short of it, all of the data is delivered here for you. I normally post these on Monday when we get updates to the trigger. Remember, this is running all on weekly data, so it updates Monday. Right now, the data I'm showing you is as of Friday, so we can recap what happened last week. So when we come back over here and we show you these triggers, this is as of the close of trading on Friday. Okay, so now the next is the TT scanner. This is the current one. This is the same one. And we are going to, what did I show you earlier? I must have it open twice. Okay, that's fine. Let's come in here and let's go to the core. We have no new triggers here. The last trigger we had was a telecommunications sector. It's short. We've already got 12% profit in this trade. By the way, pay attention to the profit in these trades. When they stick, you get decent profits fairly quickly within 4, 5, 6 weeks. This is a swing trading system for weekly trading. When they don't stick, you'll get out with maybe a 5, 6, 7% loss. And remember, you allocate a small portion of your capital anyway, so that would end up being a 0.7 or a 0.35% loss overall if you're following my instructions and trading effectively. You're not allocating 100% of your portfolio into these trades. You should be trading a very small amount into any of these trades and picking the ones that you like. But these are to help you identify trade setups and to swing trade effectively. Swing trading is 2, 3, 10, 20 weeks, maybe longer. But it's designed to catch decent trends without having to stress over, are we in and out every 20 minutes, 30 minutes, 10 minutes, and day trade. So for example, ARKW, we went short. We had an entry price of 63.78. We're currently at 46.12. We have 27% profit in the trade. Here we have the Trust XLE energy sector. We went long at entry price of 61.48. We're currently at 70.48. We have 14%, almost 15% in the trade. Here we have agriculture DBA. We went long 74 weeks ago from an entry price of 17.55. It's currently at 20.26. We've hit both targets. We have 15% in the trade. So remember, these are all great trades. Wonderful, fantastic trades. I can't explain it to you. Just look at the profit numbers. Here we have the marijuana sector. We went short 19 weeks ago at 779. It's at 474. We've got 39% profit target, and we're very close to hitting our next target at 409. We have here the XOP. We're long 32 weeks ago. We went long at 110. It's 118.61. 7.27% profit. We've hit both targets already. Remember, these targets, you should be pulling out either 25% to 30% of your targets, if not more. If you don't have a lot of confidence in the trade, by the time you hit your first target or second target, you should really only have maybe 15, 20, 25% left in the trailing position. Okay, UUP dollars, been long for 23 weeks, 13% profit. We've already hit both profit targets. Our stop is at 26.62. We're at 30.32. We entered at 26.72. So our stop right now is just below our entry price. And lastly, UGL, short for 3 weeks. We got 11% profit target. We hit our 11% profit. We hit our first profit target. Our next profit target is only about $3.40 away, roughly. And it is trending downward. So these are really wonderful trades. If you're following these become a great resource for you. Here's the core inverted system. We got 3 new trades. Look at this. TMV, Treasuries, bullish. We got 3% profit. Entry price is 119.64. Brand new trade. Haven't hit targets yet. 7 and 10 years short Treasury. This was maybe short Treasuries here as well. TMV, I'll have to look. New trade, 27.95. We got 1.57%. Moderate thrust trending. Very good setup. We haven't hit any of our profit targets yet. And then we have a new trade here in Dust, which is Bear Gold Miners. Bear is 2X Gold Miners. 8.86% profit. 25.53 it looks like. 26.53 is our entry price. And we have not hit any of our targets yet. It looks like a pretty good trade. This is a long trade and is thrusting very strongly to the upside, which is a great trade. We've got 3 new flat triggers in DRIP. So we're seeing the miners, sorry, not miners, the gold and gas exploration move flat. We're seeing the MSCI EFZ move flat and EPV Ultra Short Europe move flat. So that could be a flattening out of a move to the upside, showing uncertainty. But we have 3 new flat trades getting us out of our trades. So now lastly, I've got to come over here and show you the value, I believe. The value scan is right here. And here's the value scan. This is very tiny because we have a lot of data in here. Let me try to move this over here so you can see it. We have a new trade in Manpower Group, already up 6%. Short, we have a new trade in Nike, short. 2 existing trades here in WBA, Walgreens, and Dow Inc. We have a new trade in Salesforce, short, which is up 2% already. We have a new trade in Hasbro, short, which is up 5% already. We have a new trade in Eastman Chemical, short, which is already up 7% already. We have a new trade in Scotts Miracle-Gro, short, which is up 7% already. This trade was from last week. 3M Company short is up 9% already. And then we have some existing trades down here that are holding on. These are longer trades. Chevron Corporation's been 37 weeks, up 23%. and United Health Group has been 75 weeks up 37%. For members, I want you to understand these are opportunities for you to pick and trade swing trades. Same thing here when you come into your account. So let me come back over here and show you that when you come into your account and you log in, when you log into your account, assuming we get there, there we go. You have this menu, and I notice a lot of people don't maybe understand this. So when you log in, you have your book that you can get to, Change Your Thinking, How to Survive and Profit from Bear Market Trades. You have Trade Tank, and you have Live Trades. Now understand that down here you have the same thing. The only thing that isn't listed here that is up on this upper menu is Live Trades. And you guys need to start using Live Trades and Trade Tank to take advantage of all the resources I provide for you. So under Live Trades, when you go to Live Trades, you have to click it twice, the way it works. And this is where all of the new bullish and bearish and stock lists, including the core ETFs and everything, are running under specialized algorithms. These algorithms are different than what you see over here. So these are, here. These are the TT scanner trading algorithms on weekly data, providing you swing trading data, 2 to 16 weeks, maybe 20 weeks or longer in length. These are short-term algorithms running on daily data. So you can get conflicting signals here, but you need to understand that there's a couple of very key elements I want you to pay attention to. This has an entry, one target, take profit levels, and it has ranking. So see here, GDX just got out of a trade. It's currently ranked 18.65 and 16.23. It won 5 of the last 6 trades, and it's holding up fairly well. You can see annually how it's holding up. IBB is currently losing for the year. It's ranked 3.61 and minus 0.59. I tell people that when you're below 4.5 or 5 on the short-term ranking, don't have a lot of support in the trade, cut your trading in this trade down, maybe 20, 30, 50%, and realize that you can see here, this is the type of volatility annually you will see with the algorithm. You can see right now, this one's minus 35%, hasn't hit any targets, and it's only about a week old. Whereas when you see something like this, or like this, OIH, where it's been performing very well, ranking is very high, won 5 of the last 6 trades, it's already taken its profit target. It took a trade, what, 3-4 days ago. It's already up 11% in the trade. These are very good setups, ladies and gentlemen. And I want you to be aware that I've created a ranking system called Pure Alpha. Pure Alpha is nothing but the highest ranked systems generating and showing you trades every day. Now understand that the markets shift. We may not get trades every day. For example, out of these, if I come back over here to standard modeling, there were actually rotational, tells us there's 37 symbols in this trade, in this list. Under Pure Alpha, there is, go back here, Pure Alpha, there's 24 of the 37 symbols in this list rank as highly profitable trading consistently. And this is going to give you new triggers all the time. Look for these new triggers here to show you what's going on. And you can see we've got some very good trades. XOP, short on a daily basis, already up 12%, already taken a profit target. It's performing fairly well with very high ranking, and obviously the higher ranking, the better. Now, when you get into really high ranking, anything like 20, 30, 40, those are big movers. So you might want to look at reducing your risk a little bit in the trade, reducing your allocation, and trying to ride out the trade a bit more effectively. So now when you're taking a look at what we have available at mint.com, I want you to be aware that some very key components for you. Right now, everything is free. I eventually do plan on charging small amounts to try to maintain this. I want you to understand this takes a ton of work. It is Saturday. It is 11 o'clock in the morning. I've been working since 5 a.m. getting everything prepared, trying to do these videos and running these servers. My servers cost money. My updates in the code cost money. I've actually gone into my YouTube channel. In fact, I can show you back over here under my YouTube channel. I've created content that shows you what I'm doing here. For example, here's exploring live trades. I've created a new section that allows me to show you what I do, which is this. If you kind of really want to see, come over here, come over here, come over here, come over here. This is code. What I do is I study charts. I figure out how to make the algorithms work better. This is just all the setup. Here's the code. This one algorithm, which runs the live trade algorithms, is 1,800 lines of code. It may not seem like a lot, but it's doing quite a bit, and it requires constant maintenance and updating. Now, that produces this, which is running on one chart here, the MES on a 15-minute basis. I wanted to see what it looked like if it ran and if I created intraday strategies. So hypothetically, this is what it's done over the last couple of days on an intraday strategy. What I look at when I look at these is the historical analysis, the win-loss ratio, and then typically I come down to performance. And what I try to see is the win-loss. I need to move this. This is MES. So come in here, give you a real representation, $5 a point. And what I want you to see here is how much it makes or loses on a given basis. So here we had a bad day. We took 2 losses. Generally, I'm looking for winners to be greater than losers and losers to be self-contained. And that's going to show me back over here on the win-to-loss ratio or a drawdown ratio. Basically, it's making money, and it has a consistent self-contained risk of around $250 with occasional $400 or $500 risk. So ideally, this is holding up pretty good. And then we need to come over here to the periodic analysis and move down so you can see we don't really have weekly analysis, ladies and gentlemen, but what we can see here is historically how it's performed. So when we come back over here under the trade analysis, you can see that over the last, let's see how much longer, how this is 21 trading days, it has made $978. It's holding up okay. It's not perfect yet, but I would like to introduce intraday trading strategies to you as well. This is the same strategy that runs the live trades back here. So understand this is the same strategy that runs these. It is a fantastic strategy. It is an adaptive, artificial intelligent type of strategy. You might think, well, Brad, how can you do that in 2,000 lines of code? Well, there's external code that's pulled in through include files or libraries, which gives us what we want. And that is if we come to daily, and for example, we come to something like Allstate. You take a look here, and this is Allstate, and I'm not saying this is going to be perfect, but what I'm saying is that this is the equity curve for Allstate going back on a daily basis, and the strategy analysis is that it is 52% accurate. And where can we get the here? So you can see here, we go back monthly. It's holding its own. It has a couple of losing months, but it's holding its own. Annually, you can see here what it's been doing. It's made some money and then recently lost some money. So it wasn't a great example I pulled up, but I'm trying to make improvements to this. And what happens, ladies and gentlemen, is my job is to try to build better and better technology so that you can use it with your capital to provide better, generate better and better results. Ultimately, what do we have? We have, oops, come back here. Ultimately, you have the Mint rotational modeling system, which provides incredible results. Okay, you have the live trades section, which provides incredible results. Look at these numbers. Following these ranking systems, sticking with the best trading systems, should keep you very happy for many years to come. Additionally, over here, you have the hot list, you have the video, and when we get right down to it, you could come in and take a look at something like Symphony. If you wanted something that can generate hypothetically 8 to 15% return on investment trading futures every month, you need to take a look at this. Now I'm going to show you something here. Like here's the eMicro system. Costs about $5,000 to get started trading one contract. It'll generate around $900 to $1,000 a month. It only trades 2 times a month on average. It trades in these sectors here. It can be done on your PC or completely hands-free through Striker. And the reality is, ladies and gentlemen, would you like to be able to make about $1,000 a month or about 15 to 20% a month return on investment on a $5,000 account or $6,000 account? Hands-free, very conservatively, trading only 2 times a month. Or maybe you'd like to be a little more aggressive. How about this one, which trades, again, same setup, just a bit more aggressive. Requires $30,000 to $40,000 to get started, makes about $6,000 to $7,000 a month. So again, think about that. That's about 15 to 20% return on investment a month, hands-free. So you could start with call it a $40,000 account. You could trade one contract of these futures, and what you could end up doing over the course of a year, you would end up potentially with somewhere between $85,000 and $90,000 off of a $40,000 account, returning a 200% return on investment, hands-free, very conservatively, trading twice a month, and you don't even have to touch it. So understand, the goal here is to teach you how to leverage your investment. If you want to be a trader, fine, no problem. We can help you. The idea is we have this strategy, which should be for the bulk of your retirement money. We have the Symphony system and the Da Vinci system and others coming. Okay, and long and short of it, these should be alternately potentially set up to help you grow your wealth exponentially. And we have the live trades set up. We have the hot list set up. There's an unlimited opportunity here for you to become a trader and to just use Mint.com as the single resource for everything that you want. On top of that, remember, you have the weekly video, you have the weekly summary, which I'm putting together for you. It's endless what we can do for you. And what I'm going to try to do when I change the website and start charging, because I am going to have to start charging for this stuff, is to provide you with the resources to pick and choose and grow your account very, very cost effectively. I'm not talking thousands of dollars a year like some other people charge. I'm talking about possibly $100 or $150, maybe $180 a year to have access to all of my tools and take it as far as you want. Excluding, ladies and gentlemen, these advanced trading systems like Symphony. These cost more, and these are extra because they're not necessarily mine. They're a friend of mine's. But I'm using Symphony. I'm using this version right here, and I love it. I mean, I can't tell you what it's like to potentially generate 10, 15, 20% return on investment a month, and I don't even have to look at it. Okay? I mean, that's just incredible. When you think about it, 150 to 200% return on investment, very conservatively. No real, I mean, I can't say that. There are risks involved, but it's almost like there's no real risks involved because over time, it will continue potentially to grow the account to a point that I'm not worried about it. And imagine this can continue to grow and grow and grow and grow to the point where you could be trading 5 or 10 contracts and be making 10 grand a month with this. Same thing here. You start with one contract, you make about 7 grand a month. If you have more and you put 60 grand in an account, you could be trading 2 grand or 2 contracts. You could be making $14,000, $15,000 a month on this and just let it grow. After a year, you could be maybe trading 2 contracts or 3 contracts, maybe 4 contracts and making 20 grand a month, which is more than enough for you to live on very comfortably. All right, I've taken quite a bit of time with this. I'm going to have to probably edit it, but that's fine. I want you to see the real value of what is in Mint.com and why you need to stick with it and why you need to trust me in what I'm trying to do in delivering these success solutions. You go other places, they're going to be charging you $79 a month, $100 a month, $200 a month to try to have access to the same stuff that I'm delivering for you right here for free. Why not stick with me and help me grow this into a more suitable, more advanced trading solution for you? All right, next we'll go through the final stages of this week's update.